One of the most important steps you can make in order to be a successful investor is learning how to value a stock. And for example, if we look at Microsoft, over the past 30 or so years, we can see around 2000, they were trading at around $40 per share. And for the next decade or so, they would virtually see no returns in their share price. Now, what's the reason for this? Microsoft is undeniably a phenomenal company. They have been for a long time. Well, the problem was in early 2000s, they were clearly overvalued. And due to this, they didn't see any share price returns for about a decade. But for example, if we look at 2014, we can see they're trading at around $49 per share. Jump forward to now, it's all the way up to $375 per share. I would argue again, this is partly due to valuation. In early 2014, Microsoft was clearly undervalued, and over the long term, they've now seen phenomenal returns. So again, valuation is extremely important to understand whether or not you're looking at a phenomenal business or a bad business. You need to know how to value a stock. So in this video, I'm going to be taking you step by step on 4 different ways that you can learn to value a stock and calculate its intrinsic value. Now in this example, we'll be using a stock valuation model that I built out to help investors calculate intrinsic value. I provide it for all of my Patreon members. There's a link in my description to download it on my Patreon page if you're interested, but you can see the 4 valuations we'll go step by step through are going to be Graham's valuation, a discounted cash flow analysis, a multiples valuation, and a dividend discount model, and all of these roll into our output tab. And for this example, let's go ahead and stick with Microsoft. Now, before we dig too deep into this valuation, there's a few different things we need to discuss. And the first is you need to understand what the business model of the company you're looking at is, because it's going to be different depending on the type of business you're looking at. For example, the way we value a real estate investment trust is going to be very different than the way we value a company like Microsoft, and the way we value a bank stock, for example, JP Morgan, Bank of America, that's also going to be very different than the way we value a real estate investment trust or a more typical business like Microsoft. I'll post videos in the very near future on how to value a real estate investment trust and how to value a bank stock, so be on the lookout for that as well. But let's go ahead and jump into this tutorial on how to use this spreadsheet and how to value a stock. Now up here, we're looking at our stock screener tab. You can see we have a lot of important metrics here, and you can adjust what you're looking at depending on the stock ticker you plug in right here. So for example, if we wanted to look at Apple, we could plug in AAPL, hit enter, and you can see all of this data will automatically load in. We have our 500-day change chart, we have business metrics, we have dividend data, moving averages, and then a lot of other key metrics I personally like to look at, like analyst target price, institutional ownership, and the beta of the company, which essentially measures the company's volatility. You can also measure the amount of days you're looking at on this chart. For example, if I plugged in 365, we can now see exactly the 365-day chart for Apple, or we could plug in up to maybe even 1,500-day chart if we wanted to look at it over a much longer period of time. But that's a quick, simple analysis of how to use the stock screener tab. Just a great way to get a quick overview of the business. So let's go ahead and come back up here and plug in Microsoft and hit enter. Again, all this data will load in, but let's go ahead and jump to our first valuation, which will be Graham's valuation. Now you can see here we have 2 different formulas. We have Graham's original valuation formula, and now we have the more up-to-date formula that most people currently use. So let's go ahead and zoom in and start touching on this formula. If we come over here, this formula is essentially deriving our intrinsic value based on the earnings per share growth of the company. So let's go ahead and start breaking this out. V is going to be equal to the value of the stock. EPS stands for earnings per share. And this number we have here is our growth rate projection. That's what the G stands for. We then multiply by 4.4, which we come down here, we can see is the average yield of AAA corporate bonds. So that number will stay steady. And then we have Y. Y is going to be the current yield on AAA corporate bonds. So one of the things we want to do is plug in these variables to find the intrinsic value of Microsoft. So let's go ahead and close out Y. We'll close out our growth rate projection. We'll even close out the earnings per share. Now this spreadsheet does have the ability to automatically populate the earnings per share, but I personally like to plug in the forward-looking earnings per share. I feel like it gives a little bit of a more accurate projection. So the first metric we need is our earnings per share for the spreadsheet. So one of the places I like to look at is Seeking Alpha. It's my absolute favorite stock investment research platform. I have a link to them in my description if you're interested in getting a 7-day free trial to it and a huge discount. But again, there are other places you can go to find this information. If we look right here, we can see the forward-looking earnings per share for Microsoft currently sitting at 11.21. So that's pretty easy information to find. So if we jump back over to the spreadsheet, we can go ahead and plug in 11.21 right here, and I'll hit enter. We already have our price to earnings of a company with no growth. That's something Graham included in this formula. And now we need our growth rate projection, one of the most important parts of this valuation. So the first question we need to answer is what growth rate are we talking about? Are we talking about revenue growth for the company, net income growth? Are we talking about dividend growth, free cash flow growth? Well, again, we're looking at earnings per share. So we want to project the earnings per share growth for this company in this formula. So don't look at things like revenue growth. That does play a factor in earnings growth. But again, we want to focus on earnings per share growth in this scenario. So a few different things you may want to consider when trying to find this number. Look at analyst growth rate projection. Look at industry growth projections. You definitely want to look at historical data as well to see how the company has grown over the past decade. But remember, don't just blindly follow someone else's prediction with a growth rate projection. Do your own analysis into the company so you can find an accurate growth rate projection. And there are some places you can quickly get an idea of maybe what kind of growth rate you should go with. For example, if you go to Yahoo Finance, I believe they have some growth rate projections there as well, along with Seeking Alpha. But let's say after doing all of this research, we think an earnings per share growth rate for Microsoft of around 17 will be accurate moving forward. I'll plug in 17 right here. We already have our average yield of AAA corporate bonds listed in the formula, so the last thing we need is Y. And Y is going to be the current yield on AAA corporate bonds. And that's something you could easily Google and quickly find. For example, if you go to a place like Y Charts, even without signing in, you can see right here, current yield on AAA corporate bonds sitting at 4.52. Now this also plays a large role in the valuation we'll get, so we'll go ahead and plug it in, 4.52, and hit enter. And you can see this gives us an intrinsic value of $261.90 per share, quite a bit below that current trading price. Now, over the past few years, the current yield on AAA corporate bonds has been closer to about 3.5. So just as an example, let's plug in 3.5 here and hit enter. And you can see our intrinsic value jumps all the way up to $338.22. So again, this current yield on AAA corporate bonds plays a large role in the valuation that you get. And essentially what it does is it helps this valuation model take into account current economic conditions. But there you go, that is the first way you can value a stock. The second way is one of the most popular ways, and for good reason too, and that's the discounted cash flow analysis. And the idea behind a discounted cash flow analysis is we should be able to value a company based on the future free cash flow that they're going to produce. And a few of the other reasons that I really like this valuation is it also takes into account things like growth rate projection for future free cash flow, takes into account the total debt of the company, but it also takes into account cash and cash equivalents. So there's some other balance sheet metrics taken into account with the discounted cash flow analysis. Let's go ahead and go step by step on how to perform this valuation. We'll go ahead and take out our growth rate projection, take out our perpetual growth rate, discount rate. We'll even clear out our historical free cash flow measures. We'll clear out this data, and we'll start from scratch on how to build this. So you can see the first thing we have up here is basically we're looking for our historical free cash flow data so we can see year-over-year growth rates. Now, again, there's a lot of different places you could find historical free cash flow data, again, like Seeking Alpha, probably Yahoo Finance, but one of the quickest ways you can easily see this is a website called Macro Trends. So if we go ahead and scroll down, I just Googled Microsoft free cash flow and we can see their year-over-year free cash flow growth right here. So I'm just gonna go ahead and jump forward and plug in all of this free cash flow data right here. Okay, so I've jumped forward and plugged in the last 5 years of historical free cash flow data for Microsoft. And I think in some scenarios, maybe it'll make sense to plug in around 10 years of data if you need a better idea of the historical free cash flow metrics, but I think for Microsoft, 5 years is plenty of data. And so now we can see our year-over-year free cash flow growth. We have a year with around 18%, 24%, 16%, and the most prior year, it was down around 8.71%. So actually overall, pretty solid growth, even though we had 1 year of declining free cash flow. That's an average growth rate of around 12.34%. Now again, an important part we need to do is project a growth rate to the future free cash flows for this company. And just like we did with the earnings per share growth rate projection, we need to take into account things like analyst projections, industry projections, see what we think for ourselves, and also look at that historical free cash flow growth rate. Let's say after doing research into this number, again, we think around 16% free cash flow growth will be accurate for Microsoft moving forward. Once we've done that, we can find the future free cash flows for the company. And you can see this actually automatically filled in with my stock valuation spreadsheet, but you can see right here the formula that we use to project the future free cash flows. Essentially, we're taking the latest year of free cash flow, which in this case is 2023, and then we're applying our growth rate projection, 1 plus K9, which in this scenario would be the growth rate of 16%. Move forward to the next year, and we're basically doing the same thing. We're taking 2023's free cash flow and applying our growth rate projection to it. And so I do this for around 10 years out. But after that, we need to find the terminal value of Microsoft. Now, if you're wondering what terminal value is, that's a good question. Terminal value is essentially the value of all the future free cash flow in this scenario past the year 2031. And to find the terminal value of any company using a discounted cash flow analysis, two things we need are a perpetual growth rate and a discount rate. So let's go ahead and touch on these metrics real quick. A perpetual growth rate is essentially going to be the rate at which the economy grows at moving forward. And for the most part, this is going to sit at around 2.5%. So that's a number I typically don't change. I keep it at 2.5%. But now we have our discount rate. And there are ways that you can manually calculate discount rate, but most investors will use around 7 to 9% depending on the type of business you're looking at. And let's say in the case of Microsoft, we want to use a discount rate of around 8%. Now that we've plugged in these numbers, you can see we have our terminal value automatically plugged in, and you can see the formula for it right here. Basically, it's taking things into account like our most recent year of free cash flow, and it's also taking into account our perpetual growth rate and discount rate. So if you're trying to build this out, go ahead and pause the video and copy this formula right here to get the terminal value. But once you've done that, the next step is extremely important. If we're projecting out future free cash flow, we need to know what the present value of those future free cash flows are. So you can see right here, basically, I've used a formula to find what the present value of the future free cash flow is. And I've done that for all the future free cash flows moving forward. So again, it's basically the same formula for all of these numbers here. Again, finding the present value of those future free cash flows, an extremely important step in this process. Now, once we've done this, it actually gets quite a bit simpler. All we need to do is add all the present value of the future free cash flow together, and that's what I've done right here. You can see I used a sum formula to add all of those future free cash flows together. But the next step is we need to add the company's cash and cash equivalents. And again, this is something you could find a lot of different places, but for this example, let's go ahead and go over to Yahoo Finance. And again, we're looking for cash and cash equivalents, and that is a metric you could find on the balance sheet. So if we jump over to the financial statements, I'll click on financials, scroll down, we'll click on balance sheet. This will be under total assets. So if we click on assets, click on current assets, right here you can see the cash and cash equivalents for Microsoft, currently sitting at around 111 million. So let's go ahead and plug this number into our spreadsheet. We'll plug in 111, go back over, and we can see we have 262. So I'll go ahead and plug that in and hit enter. And now we need to plug in the total debt for this company as well. So if we go back over to Yahoo Finance, scroll down, we can find total debt right here, 59965. We'll go ahead and plug that in and hit enter. And now we have the equity value of Microsoft. That leaves us with one more step, and that is to divide by shares outstanding. Again, this is something we could find a lot of different places, but we're on Yahoo Finance. Let's go ahead and stay there. If we go over to the statistics tab, I'll scroll down and we can see our shares outstanding right here at 7.43 billion. So if we go ahead and come over here, we'll plug in 7430 and hit enter. And you can see we now have the intrinsic value of Microsoft with a very simple formula. We just took the equity value dividing by the shares outstanding, and that gave us our discounted cash flow price per share of $374.43, which is actually right at the current trading price for Microsoft. Again, this was just an example. I used example growth rates and discount rates, but again, you can see just how effective this can quickly be at finding the intrinsic value of a stock and helping you know what the actual value of a stock is. Again, this is one of the most popular ways to value a stock, so if you can get this method down, it could really help you out a lot. Now we have two more valuations to go. They're quite a bit more simple than the discounted cash flow analysis, but still can be extremely effective depending on the scenario that you use them in. So let's go ahead and jump over to our next valuation. And what we're looking at now is our multiples valuation. And you can tell there's not a whole lot going on here yet, but I'll go ahead and explain exactly what is going on with this valuation. And the idea behind our multiples valuation is we should be able to value a stock like Microsoft based on how the market is valuing stocks that are similar in structure using a price to earnings multiple. So for example, with my automated spreadsheet, all we would need to do is come up here and plug in some similar companies. Maybe we think Apple is similar. Again, this is just an example. I'll plug that in and you can see the company name will automatically load in, their stock price, and the earnings per share. and then the price to earnings multiple. And really the price to earnings multiple is just the stock price divided by the earnings per share. So again, Apple has a price to earnings multiple of 30.06. If we jump back over to our stock screener, we can see Microsoft's price to earnings sitting at 35.89. So if we jump back over to our multiples valuation, let's go ahead and plug in another comparable. Let's say after more research, we think the closest company in structure to Microsoft would be Amazon. Again, this is just an example. I'll plug in Amazon and you can see we have our price to earnings multiple. Maybe we plug in another company like Meta. I'll plug in Meta and you can see all of this data will automatically load in once again. So now we have some comparable companies for the stock we're trying to analyze. And the average price to earnings for these companies is sitting at 46.139. Again, that's just the average of these numbers listed right here. Once we have the average price to earnings of some comparable companies, what we want to do is multiply that by Microsoft's earnings per share. And again, my spreadsheet can automatically do this, but I'll quickly show you how it works. You just need to plug in the equal sign, take this number here, and multiply it by the earnings per share and hit enter. And you can see in the scenario, Microsoft's intrinsic value would come out to $476.62. Now, one of the things you may notice is we have one company that is way different than the other companies we're looking at. It's a little bit of an outlier. Sometimes when this is the case, you may decide it makes more sense to use the median price to earnings, which is quite a bit different than the average in this scenario. A lot of the times that is an indicator that you should be using the median price to earnings. So let's go ahead and switch up this formula. We'll do equals, we'll take the price to earnings multiple and multiply it by Microsoft's earnings per share and hit enter. And you can see we now come to an intrinsic value of $320.57, a pretty big difference in this scenario. So the multiples valuation is relatively simple, but again, it can be a really effective way to quickly see how the company is valued compared to how the market is valuing other companies that are similar in structure and similar in nature. So the last valuation we'll now look at is the dividend discount model. And this is one of my favorite ways to value a dividend paying stock. And the idea behind it is fairly simple. We should be able to find the intrinsic value of a stock based on how much they're paying out in dividends and how much that dividend is going to grow over time. So let's go ahead and clear this out, talk about exactly what's going on here. I'll clear out the growth rate and discount rate so we have a clear basis. The first thing we need to do again is look at some historical data for the dividends. And again, we're looking at Microsoft. So in this scenario, let's go ahead and jump back over to Seeking Alpha, one of my favorite platforms to look at dividend metrics, because if we come here and click on dividends, click on dividend history, we can quickly see how much they pay out in dividends. And it looks like their most recent quarterly dividend payout was around 75 cents per share. So what I'll do is I'll come right here and plug in current 0.75, and keep in mind, this is the quarterly dividend payout. So when I hit enter, my stock valuation spreadsheet will automatically tell us what that yearly dividend payout is. But if you don't have it set up to be automatic or you're making your own, just multiply this number by 4, which comes out to 3 in this scenario. So let's go ahead and plug in this other historical data. You can see before they were paying out 75 cents per share. It looks like they were paying out around 68 cents per share, but I'll go ahead and jump forward and plug in this data. Okay, so now I've plugged in all the quarterly dividend payouts over the past 5 or so years for Microsoft, and we can see the yearly dividend payouts from Microsoft after multiplying them by 4. Now be sure to make sure you know if the dividend stock you're looking at pays out semi-annually, maybe once per year, or 4 times a year, or even monthly, because that will obviously change the amount you need to multiply those dividend payments by. But again, in Microsoft's scenario, they pay out 4 times per year, so we multiply that number by 4. Once we've done this, we can now see the growth rates year over year for all of these companies. And again, here is the formula for growth rate right here. If you're making your own, be sure to pause the video and use that now. But we can see year over year dividend growth rates of 9.8%, 10.71%, 9.68%, and 10.29%. If we average those together, you can see my average formula here, but we come to an average dividend growth rate of around 10.12%. That's important data for the projection we now need to make, which is the dividend growth rate projection. And again, there are a lot of things to take into consideration when you want to apply a dividend growth rate. And just like the discounted cash flow analysis and Graham's valuation, you want to apply a lot of different things such as analyst projection, industry projections. You want to do your own research. You definitely want to look at historical data, but in my opinion, one of the most important things you can do is 1, look and see if the company is growing their free cash flow, which again, that kind of goes in line with looking at our discounted cash flow analysis and seeing how much growth we projected to the future free cash flows, because if they're growing free cash flow, they should be able to pay out dividends. Dividends are paid out of free cash flow, so if a company is not growing free cash flow, they can't pay out growing dividends. So that's extremely important to understand. But one of the other things you should do is also see if management has put out any statements about their projected dividend growth. A lot of companies like Altria will state exactly what their target dividend growth rate is, and again, that's a great insight to projecting a future dividend growth rate. The last thing you obviously want to take into account is if we jump over to Seeking Alpha, and that's looking at payout ratios. And first off, if we jump over to my stock screener, you can actually see that's something that automatically fills in. For Microsoft, that payout ratio is currently looking at about 28.09%, which is a nice low payout ratio, so nothing to concern. But if you jump over to Seeking Alpha, you can click on Dividend Safety and look at a lot of other key payout ratios that could be really important, such as the cash flow payout ratio, because again, dividends are paid out of free cash flow. But once you've taken all of those things into consideration, that's when you want to apply your dividend growth rate. So in the case of Microsoft, in this example, it looks like they're able to grow dividends at a pretty high rate. So maybe I think a dividend growth rate of around 8.25% is going to be accurate for this company after digging into it. Now, the last thing we need, again, is our discount rate. And again, discount rate is something we've already looked at with our discounted cash flow analysis. Let's say for this example, typically you want to stick with the discount rate you go with for your other models, but maybe in this scenario, we think a discount rate of around 9% is more accurate for Microsoft. So I'll plug in 9% and hit enter, and you can see this gives us a dividend discount model price per share of $433. So again, that's how we can calculate the intrinsic value using the dividend discount model. And something I love about my stock valuation tools, I built an output tab so we can easily see all 4 valuations on one page. We have grams at 261, multiples at 433, DCF at 374, and dividend discount model at $433 per share. And when you average those 4 together, we come to an intrinsic value of $375.58, extremely close to that current trading price. It's only off by about 1.33%. Now, once you've done all this, something that I think every value investor should do is apply a margin of safety. This is simply to protect ourselves from any errors in our calculations. Margin of safety is something everyone should consider. So with a 10% margin of safety, our acceptable buy price for this company becomes around $338 per share, meaning it's not quite within our acceptable buy price. With a 20% margin of safety, our acceptable buy price is sitting at around $346. Sitting at about $300.46 per share. Again, not quite within our buy price, but again, if you look at the price history from Microsoft, jump back over to Seeking Alpha, you can see within the past year or so, there have been opportunities to buy Microsoft at around that range. So again, there are opportunities, but you have to know what the value of the company is to know whether or not it's a good opportunity or a bad opportunity. But there you go, that's how you can calculate the intrinsic value of a stock, and that's how you can learn to value a stock 4 different ways. The valuation model that was used in this video is one that I originally built for myself, but have started sharing on my Patreon page and has been used by thousands of others. It makes the process quite a bit more simple and quite a bit more automated, which is phenomenal if you're someone looking to perform multiple valuations on different companies. Now again, I want to state that the way you value real estate investment trusts and bank stocks is radically different than the way you would value a more typical company like Microsoft. So again, I will make videos on how to do that in the near future, but I also have spreadsheets focused on valuing real estate investment trusts and bank stocks, and both of those are available on my Patreon page as well. But with all that being said, go ahead and let me know what you think of these 4 valuations, if you think one of them is better than the others, or if you think one is worse off than the others. And if you have any questions, be sure to leave it in the comment section down below. But with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.